An exchange-traded fund is a basket of securities you can buy and sell during market hours through a single ticker, combining mutual fund-style diversification with stock-like trading flexibility in one vehicle. In practice, many ETFs passively track a market index, so the fund's job is to mirror the benchmark's performance rather than beat it, which reduces ongoing decision-making and helps keep costs low over time. Under the hood, large institutions called authorized participants create or redeem ETF shares in big blocks by exchanging baskets of the underlying securities for ETF shares and vice versa, a mechanism that helps keep the ETF's market price close to the value of what it holds. Because ETFs trade intraday, you can place market or limit orders and see real-time quotes, but you also face bid-ask spreads that act as a small variable trading cost on each buy or sell. Those spreads are usually tight and broad, liquid ETFs, but can widen during volatile periods or in funds that hold less liquid underlying assets, so using limit orders is a simple way to control execution. The total cost of owning an ETF is more than just the headline expense ratio because spreads and, if applicable, commissions can add to your all-in friction, especially if you trade frequently. Many U.S. brokers charge zero commissions on ETF trades, which makes the expense ratio and typical spread the two big levers you can compare when choosing among similar funds. Over multi-year horizons, shaving a few basis points of annual fees compounds into meaningful differences, so favoring low-cost, tightly tracking funds is a practical edge. Accessibility is another draw. ETFs generally have no investment minimum beyond the price of one share, and many brokers support fractional shares so small, recurring contributions can fit any budget. That setup pairs naturally with a fixed contribution cadence, such as monthly dollar recost averaging so volatility turns into scheduled share accumulation without constant decisions. Taxes are part of the ETF story in the US, because the in-kind creation divided by redemption process can reduce capital gains distributions at the fund level compared with mutual funds that may need to sell holdings to meet redemptions. You still owe taxes on dividends as they're paid and on your own gains when you sell, but many ETFs historically have distributed fewer taxable capital gains, improving after-tax compounding for buy-hold investors. That's one reason broad, low turnover ETFs are often considered tax-efficient defaults for long-term, taxable accounts when paired with a sensible holding period. Choosing an ETF starts with knowing what you're actually getting, so check the index methodology, top holdings, and how and when the benchmark rebalances. Compare expense ratios, look up typical bid-ask spreads, and review tracking difference to see how tightly the fund has matched its index after fees. Fund size, issuer stability, and on-screen liquidity matter too, because deeper markets generally mean tighter spreads and smoother execution when you place orders. If your plan is set one forget, broad core ETFs that cover the total US market, international markets, and high-quality bonds can deliver massive diversification at very low cost in one or two trades. Niche or thematic ETFs are best treated as small satellites, not the core, so a single story doesn't dominate your risk and tempt mid-course tinkering. Trading hygiene is straightforward. Place limit orders near the current bid-ask midpoint, avoid the first and last minutes of the session when spreads can be wider, and let automation handle your recurring buys whenever possible. If your broker supports automatic dividend reinvestment, turning on DRIP ensures distributions immediately buy new shares, keeping more of your money working between scheduled contributions. For many investors, IRAs and Roth IRAs are an ideal home for broad ETFs because zero commission trading plus tax-advantaged growth keeps friction low while you build for the long run. In employer plans, menus often emphasize mutual funds, but if a brokerage window is available, it may offer ETF access, confirm costs and features before using it as your primary channel. Risks to respect are mostly about process and fit. Every ETF has some tracking difference, Liquidity is a function of both the ticker and its underlying holdings, and intraday access can invite overtrading if you lack rules. The antidote is the same disciplined behavior used with index mutual funds. Define your allocation, automate your cadence, prefer low cost and broad diversification, and limit changes to scheduled rebalancing or life-driven contribution updates. Conceptually, ETFs and index mutual funds are cousins that often track the same benchmarks, with the big day-tra-day differences being intraday trading, spreads, and the plumbing that can affect taxes and convenience. If you just learned why index funds win quietly, think of ETFs as the more flexible wrapper for the same idea: market exposure at low cost, so your calendar, not your feelings, drives the next buy. To put this into action in under a minute, pick a broad, low-cost core ETF, confirm the ticker and expense ratio, place a limit order, enable dividend reinvestment once it fills, and schedule a recurring transfer synced to your payday. Keep the order type and timing consistent, review spreads before large allocations, and let your contribution, cadence, and reinvestment do the compounding while you focus on staying the course. Next, dig into a focused comparison of ETFs versus index mutual funds costs, taxes, and convenience across U.S. accounts so you can set a default wrapper that matches your plan without second-guessing future moves.